Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, I'm going to be showing you the return-based valuation strategy that I utilize, looking at the free cash flow of a company and determining what a fair value is. And this is the way that is taught at the Columbia School of Business. Bruce Greenwald is maybe not the pioneer of this method. The pioneer really is Benjamin Graham, but he's the one that really brought it out into the public light. So I hope you enjoyed the video. So let's get right into it. So the first step basically in the return-based valuation process is looking at the free cash flow of the company. So usually what I like to do is I like to take the average 5-year free cash flows. So let's take these average 5-year free cash flows for Home Depot, 12.4 billion. Okay, those are the average free cash flows over the past 5 years per year. And I like to see if they pay any dividends. So let's look at total dividends paid. And they do. So on average, they paid out $6.1 billion worth of dividends. So minus $6.1 billion in dividends. This means that over the last 5 years, on average, Home Depot, 12.4 minus 6.1, has retained $6.3 billion per year and reinvested it back into its business. It's made $12.4 billion in free cash flow. It's paid $6.1 billion out to its shareholders, and it's retained $6.3 billion per year over the past 5 years. Let's look at their ability to deliver returns on their capital, meaning for the money that they retain, how much money do they make? Home Depot delivers on average a 50% return on its capital, meaning for every dollar that they keep in the business, the $6.3 billion that they reinvest, they make 50 cents on it, or 50%, meaning they retain the earnings, or they retain those free cash flows, and what do they do with them? They make money on it, and they make it at a very high rate. For every dollar, they make an extra 50 cents per year. Okay, so they deliver a 50% return on that capital, 50%. Home Depot delivers a 50% return on capital. If we divide this return that they deliver on the money that they retain by the cost of capital, now we can look up Home Depot's cost of capital. I already did for you. It's right here. Home Depot's cost of capital is probably 8%. I like to be conservative and add a percentage point. So if people online are saying the cost of capital is 8%, guess what I do? I use 9%. So Home Depot delivers a 50% return on its capital. Its cost of capital, in my opinion, costs 9%. Why? Because other people says it's 8%. I like to be conservative. I add a percentage point. This means that if we take the cost of the return on capital, 50%, divided by the cost of capital, 9%, we get a value creation factor of 5.6. So this is 9%. This equals our value creation factor, and what is it? It's 5.6. 50 divided by 9 is 5.6. This 5.6 is our value creation factor. The value creation factor is equal to the return on capital divided by the cost of capital. We look at Home Depot's business. They are retaining $6.3 billion every single year and putting into the business. What we can do is we can multiply this $6.3 billion, let me do it in a different color here, by this value creation factor. Let's do that right now. That gives us 35 billion. So what this is saying, let's go through it one more time. Every year, Home Depot, on average over the last 5 years, makes $12.4 billion in free cash flow. They pay out $6.1 billion in earnings per year over the last 5 years, on average. Meaning they retain $6.3 billion and reinvest it back into their business. On that money that they reinvest back to the business, year after year, they earn on average 50% on it. That's a lot of money. They earn 50%, but their cost of capital is only 9%, meaning the rate of return that is needed in order to attract investors is 9%, meaning they earn 5.6 times above their cost of capital. We take the retained free cash flows, or the reinvested money back in the business, and we multiply it by our value creation factor. We get a value of 35 billion. Now what we do is, for Home Depot, we take their enterprise value and we divide the 35 billion that we got by their current enterprise value in billions, divided by 328. That gives us a 10.7% roughly yield. Let's do it in red. So what this is saying is from Home Depot, we get a 10.7% cash yield. In addition to this, we also have to take into account the dividends that are paid out to investors. Home Depot pays an average of a 2.1% dividend, so let's add that on. And the buyback yield. 2.9% additionally. So what this is saying is that Home Depot will yield us a 10.7% cash return, plus a 2.1% dividend yield, plus a 2.9% stock buyback yield. So in total, Home Depot will yield us 15.7% per year. What does this mean? This means that there is a high likelihood that if we were to invest in Home Depot today, over the next 7 to 13 years, let's just say 10 years, Home Depot will deliver us a 15.7% annualized rate of return. That's what this is saying. And the reason why we know this, or at least can predict this, is because of Home Depot's ability to deliver high returns on capital relative to the current price, which is factored in with the enterprise value that we ultimately divided by. Does that make sense? To get this 10.7%, what we need to do is take this $35 billion, which we got from multiplying the $6.3 billion that was reinvested in the business by the value creation factor. That gave us $35 billion. $35 billion divided by the enterprise value of $328 billion gives us a 10.7% yield. We add the dividend yield and the share buyback yield, and then that gives us a price, or rather a rate of return for Home Depot of 15.7%. So I hope that makes sense. This is the return-based formula for determining if something is a worthwhile investment based on the rate of return. Obviously, this is not saying Home Depot is a wonderful investment. You still have to do your research in terms of the actual company itself, what their future prospects are and their management and so on. This is just looking at the company's ability to deliver returns, or its historical ability to deliver returns on its capital. So I hope this video was informative. Please like it and subscribe. Thanks.